Most people, we bought a single family home, put a basement suite in there. This was in 2019. Prices went crazy high during COVID.
So it's an insurance program which helps the lender to give better terms.
Correct.
In case of defaults, like
Yes.
the lender's not on a hook, right?
But the real advantage, which isn't so much the rate, but it's the fact that conventional deals, they underwrite to.
Welcome back, you guys, for yet another video. So today's specific video, again, we're going to dive into CMHC MLI Select, why you should be taking advantage of this program, a little bit of construction side of CMHC MLI Select as well. And then I'm joined with Larry from Canada ICI. They do a lot of volume in terms of CMHC deals. He's an expert, so no better person than him. So welcome to the show, Larry. How are you doing?
I'm doing well. Thank you very much.
Okay, sweet. No, let's dive right into it. So obviously right now, CMHC MLI Select has been there for how many years now, Larry?
I think since 2021, so it is a fairly new program.
Yeah, so it's about, what, 4 years now, hey?
Correct.
And then now is when everyone's really taking advantage of it. Now everyone knows they can buy something with as low as 5% down payment.
Correct.
And get up to a 50-year amortized mortgage and a lot of good stuff. And first things first, right? If you can, give us a quick background about yourself for people who don't know you, and we'll go from there.
Yeah, so my name is Larry. I guess my family, we immigrated to Canada when I was about 6 years old. I grew up mostly in Calgary, and then I went to Ontario to study engineering. Ontario is kind of where I got the exposure to real estate. The investing community was massive there, and there's a lot of opportunities to take advantage of. So my partner, who is now my wife, we start, I guess, very similar to most people. We bought a single family home, put a basement suite in there. This was in 2019, so we kind of took advantage of the fact that prices went crazy high during COVID and interest rates went really low. So we were able to do basically a perfect burr out of that.
Time the market.
Yeah. Time the market, right? But from there, we were like, oh, this is a pretty fruitful journey that we had. So we tried a few different things. We did Airbnbs. We tried some wholesaling, flips.
Oh, yeah. Okay.
Private lending. In 2022, we ultimately, my wife and I, we ended up moving back to Calgary just to be closer to home. At around the same time, I had joined Canada ICI, which is a commercial financing institution. That was kind of where I got the initial exposure to CMHC. We looked at so many deals, different structures, different deal sizes, and that eventually led me to do my own deal just outside of Calgary.
Yeah, no, that's fine. So before we break down all your personal deals in terms of CMHC, I know it's a great deal. How can we simply break down for someone who's very new to this program, who don't know much about it, if you were to break down in simple terms or layman terms, just for the CMHC MLI Select?
Oh, it's a big question. So I guess to provide some context, CMHC, the MLI Select product, MLI stands for Mortgage Loan Insurance. So CMHC, they're a government-owned company, and what they're doing is that they're providing mortgage insurance if you end up defaulting. So how they end up giving you that insurance is they have a very specific underwriting program. But once you're approved, what it allows you to do is it gives you the opportunity to get higher leverage. So when we talk about CMHC, the MLI Select program is only for multifamily product. So that's 5 units and more. And when you're in the 5-unit space, you immediately go into the commercial financing space. And in the commercial financing space, it is a little bit different than residential, where I guess the main focus is on the property and how much it cash flows, versus when you're doing a residential mortgage, it's more about your personal income and your ratios. So with CMHC, they specifically with the MLI Select program, if you can meet one of 3 criteria, so affordability, energy efficiency, or accessibility, they give you points, and once you get enough points, they allow you to get up to 95% leverage and 50-year amortizations. So that is the benefit, and I guess a quick summary of that, the CMHC product.
So like, so it's an insurance program which helps the lender to give better terms
Correct.
in case of defaults, like
Yes.
the lender's not on a hook, right?
Yeah.
So the risk for a lender is less, but the CMHC, it's a federally backed program, so they just take an extra
Yeah.
protection or whatever for the lender.
Yes.
And now, what rates are we seeing? So, compared to a normal, I know like you guys do a lot of commercial, and a normal commercial mortgage is where you have to put what 20 to 30% down on a property. And what interest rates are we seeing in comparison with a normal commercial and then also a CMHC?
For the equivalent of deal, I would say the conventional deal, the interest rate is about 1% higher.
Okay.
It is a little bit different because with the CMHC product, you're based on the Canadian Mortgage Bond, the CMB, whereas with a conventional deal, you're usually priced on the Government of Canada bond or a lender's like internal cost of funds. But I would say usually it's about 1% higher. But the real advantage, which isn't so much the rate, but it's the fact that conventional deals, they underwrite to usually a 1.2 or 1.25 debt service, and they have a 25-year amortization. Most of them, they cap it to 25 years. With CMHC, you underwrite to a 1.1 debt service, and you can go up to 50 years. And so that makes your mortgage payments much lower for the same loan amount, and therefore you can get a much higher loan amount.
So basically, it just allows people who are starting off with not a lot of capital or not a huge net worth per se to be able to get into these multifamily deals. And I think this is a small window of opportunity in the long run that we have seen, or else it's just multifamily just in general has always been like a big player's game and people used to pay residential. Now it's just an opportunity. The way that I see it is just an opportunity for younger players who wants to get ahead in the game to be able to invest and take advantage of it.
Yeah, it is true.
What's the risk involved? Yeah. Let's hear it.
It is like, I wouldn't say, if you don't have any capital or no net worth, you just go get into it, right?
Yeah.
Like there's still requirements that you need to meet. Like, for example, you have to have a net worth of 25% of the loan amount. That's the basic qualifying criteria. And so there needs to be some level of comfort for a lender or an insurance company to say, hey, like there is some collateral if you do default on this type of deal. I would say the major risk, a lot of people don't really see this, is that they think 5% down, that's all I need, 5%.
Yeah, closing costs.
Yeah, you have. I would say if you're doing a deal that qualifies you for 5%, you should budget at least another 2 or 3% for closing costs, and that includes like lending fees, legal fees, all the appraisals, the environmental, all the other reports that you need to get. It's not just like 5%, set it and forget kind of thing. Like there are other fees involved.
So how often are you seeing someone just being able to qualify? The 25% net worth. Okay, so let's just break down the 25% net worth, right?
Correct.
So what is net worth? So I know that one person can come on the table, or it could be 10 people coming together, form a corporation,
Correct.
and then they have to file or sign into the personal guarantee stuff.
Yes.
And basically pledge those assets, which is the 25% net worth. So what's included in the 25%? The main reason that I ask you this question is there's a lot of business owners who's got multiple companies.
Yeah.
Would a business valuation count?
Yeah, it would. In some cases, they might ask the individual to provide a guarantee for that business, which in most cases, if they're comfortable doing it, they will. The hard part is getting, like, it can't be like an insane valuation of that business. It has to be quite reasonable. For us, the most conservative way to value that business is the company's retained earnings. So we might take a look at that. The other things that would be part of that net worth would be like equity in real estate. So it could be if you have an appraisal and you can send us a mortgage statement, that we can calculate the difference, and that would be the equity you have in, let's say, a primary residence, right?
Yeah.
Cash is obviously part of that net worth.
How long has it supposed to stay in the account if it's just cash? Can someone just throw in a bunch of cash in the account? Like, what's the time?
Yeah, that's fine. That's fine. So for net worth purposes, there's no amount of money or the amount of time you have to season the money.
Oh yeah.
That's actually for a lending. It's for FinTrack purposes
Right.
to trace where the money's coming from.
Right.
But for net worth purposes, it doesn't matter. Like we can just have a snapshot of the cash today, and that should be sufficient to provide a guarantee. Something else would be like stock investments.
Yeah.
A lot of people have quite substantial stock investments that they don't want to sell. Usually we can use the net worth from there. If you have RRSPs and TFSAs, we can take those into account as well. But most lending institutions, they'll discount the value of it. So if you have, call it 100,000 in RRSPs, we might assume that it's worth 50,000.
Wow.
Yeah.
Okay, almost half, eh?
Yeah.
And so in terms of, let's say, a common question that I always get is, let's say if someone has a few houses and he pledges it, or the net worth is from, let's say, 3 houses.
Yeah.
And let's say the term for the mortgage, as you were saying, is going to be locked in, let's say 10 years.
Correct.
And can he sell that property in between? Like once he's qualified, once he's approved?
Unless there is anything in the COI that retains the equity, yes, there shouldn't be any issues. Because when you sell it, it usually doesn't affect your net worth, right? You're getting cash in return for a property that you used to have.
Yeah, that's fair enough.
Yeah, I would in most cases, like we as lenders, we don't even know if somebody would sell it, right?
That's
like
true. Yeah. How do you track it? Right?
Exactly.
Yeah.
So,
I see.
It's a good question.
So apart from the net worth, now let's get into the closing costs. So with a 5% down payment, so typically in any sort of funding that you have seen for these multifamily, whether it be an eightplex or a triplex or even larger unit, 60 to 100 unit multi-story buildings, are you actually seeing a lot of applications which is getting approved only for a 5% down, or?
When it comes to, let's say, term financing, like you're just purchasing it from a builder, the way to make that work is you have to get it at a decent price. Like in my head, if I can find a deal for $3 million in Calgary net of GST, I think that will qualify for 5%.
5% down.
Yeah. But if it's like 3.2, 3.3, then you'll have some challenges. That's just based on experience doing these types of deals. Obviously, how we underwrite these is we take a look at the potential rents that we can get from these buildings. And so that kind of takes us to, looking at market comparables. I would say like 12 months ago, last summer, when rents were just skyrocketing in Calgary, like every deal was able to get.
Appraisals were coming way higher.
Yeah,
as well.
exactly, 95%. And it was because like all the finance institutions, we could see that like rents were they just kept going up month to month.
Everything was positive, right?
Yeah. But I think now with the environment that we're currently in, lenders have stepped a little bit back. So we can't nearly push for that type of leverage anymore unless you can get it for a reasonable purchase price.
Okay, fair enough.
Yeah.
And so in terms of the closing costs, you said around maybe 2 to even 3%.
Correct.
So if you can quickly break down.
Yeah, so most of the times you'll have to go through, it's a CMHC approved lender that has to submit the application. And many of these guys, they will charge like 1% just to make the application. So that's 1% already. Once you actually get the COI, there could be additional lending costs, like a lender fee or something like that. That could be between 0 to 0.5%. And then you have things like legal costs, which is the big one. In the commercial space, you have to, the client has to pay for both the lender's lawyer as well as their own lawyer. And that added together is usually about $15,000 to $20,000. Yeah. And so when we're talking about like a $3 million deal, an eightplex, it adds up to 2 to 3%. And then you have all your other fees, right? The CMHC application fee, there's an appraisal cost, which is usually around $3,000 to $4,000. Your environmental costs, which are $2,000 to $4,000, and any other type of reports that the lender would want.
So and then so 5% down payment minimum, and then let's say 2 to 3%
Correct.
that they have to have it
Yes.
as liquid,
Yes.
as cash in account, credit card, line of credit,
Yeah.
which they can access into. And what about just in general with the 25% net worth, which we touched base on? How much liquidity does the CMHC or the lender requires for?
We just basically need to see that they have enough capital to close on the deal. So that includes all the things that we're kind of estimating, or they have, if the deal is like 6 months from now,
Yeah.
we see that they have a job earning $500K a year or something, that they have the income in place to support that closing costs. We'll be fine with that. But if you're talking about construction,
Yeah.
then most lending institutions will have a criteria that is they'll need to see liquid assets of 10% of the hard cost to build the project.
10% liquidity when someone's going construction financing with
CMHC
CMHC.
construction, correct. Yes.
And then, so with CMHC, I know there's multiple lenders out there. Obviously, we have the big banks and we have
Yep.
other lenders. So what are you seeing in terms of, like, I know anything over 5 million gets touched by the bigger banks, but anything less than that, it's probably different lenders like
Yeah.
Equal Capital.
Yes.
So which are the lenders that you're seeing that you guys are mostly working with, let's say for smaller deals and also for bigger deals?
I mean, you basically touched upon all of it. Like we work with both, like bigger institutions and the smaller ones. I wouldn't say PKIL is a small institution.
Yeah, I mean,
They still do billions every
yes,
year, right?
yes, yeah.
And we do big deals with them as well. Like
Yeah.
they're very competitive. Like most lending institutions, if they're willing to touch the small ones, they'll also be very competitive on the big ones.
Yeah, bigger
Yeah.
ones. Okay.
It's just that the smaller ones, they're usually not banking institutions. So
Mhm.
meaning you can't just open a deposit account with them and
Yeah.
have like a credit card or a bank account with them. Like you can't do that with PKIL as far as I know.
Yeah.
But like if you're with TD or like a Scotiabank or something like that, you can actually get like
The
maybe you're an
banking.
existing customer with them, and then
Yeah.
they will also do your CMHC deal.
Question: can someone go directly to the bank and get the CMHC, or do they have to go through the broker?
It depends how they're set up. So you brought up a good point, which is about 12 months ago, CMHC made it so that whoever submits the application has to be the one to finance it.
Okay. I mean the lender.
Yeah, exactly. And there's many reasons they decided to do that. But apart from that, you can go to certain institutions and they'll be willing to do it for you. But most institutions aren't equipped to put together applications. And so they rely on brokers to do the initial due diligence, put together the package, and then they'll review the package and make the application.
Gotcha.
Yeah.
Okay, no, it's good to know.
Yeah.
So I was trying to see like if someone can save that cost a little bit.
Yeah.
Right,
I mean,
but-
they'll still charge you to do it.
They would
That's-
still charge. Yeah. Okay, fair
yeah.
enough. So let's say someone, gets into property, gets a CMHC approval, and then just in the approval right now, like how long is it taking? I know first you got to put in all the documents together, which is your personal net worth about the property itself,
Correct.
and the environmental, the appraisal, and then
Yeah.
you put in the application and you choose the lender, and then it goes to the CMHC. What's the total timeline we're seeing?
The short answer is about 5 months.
Wow.
Yeah. The breakdown of that is, let's say you came to me with a deal that you want to do. It would take us about 4 weeks to put it together. And most of that is waiting for the appraisal to come in. That's assuming you don't have one in place.
Yeah.
So we put the application together. Like ICI, we're also a lending institution. So we actually lend on many of our deals that we do. So
Okay.
if we do that, it could save us quite a bit of time.
Mm-hmm.
But that process where we basically do the due diligence internally with our funding team, that takes about another 2 weeks. So you're at like 6 weeks now. Submit it to CMHC. CMHC, like I can never give you an exact timeline for how long they take, but it usually is between 4 to 8 weeks that you'll get a COI.
Mm.
Let's say we're on the longer end of that, right? So that's another 8 weeks on top of 6. You're at 14 weeks. With the COI in hand, most lenders take about another 4 to 6 weeks to close.
Mm.
So you're about 20 weeks in total.
So any deal someone's doing it, even though let's say they have all the net worth, they
Correct.
know the building is
Yeah.
qualified. ideally they still need to have about 3 to 4 months of a condition period until
Correct.
you get the COI.
Yeah.
Only then they are safe.
Even when you have the COI, it doesn't mean that you're safe.
Okay.
Yeah.
What's the risk after you get the COI and you waive the conditions on a deal?
The risk is if something comes up that was unexpected, maybe because one of the things is you don't actually need to do an environmental before you make the application. The environmental happens, you can do it after you get the COI.
Yeah.
So let's say that you do this entire process, you get to the COI, and then you find out that the site is dirty, right? You end up doing a phase 2, which is like $20,000, and you find out that it's dirty, and then you have
There's
to
no
do a
way
phase,
around.
yeah, and then you have to do a phase 3. And
So it's a conditional release upon the ESA.
yeah.
But apart from ESA, is there anything else that?
Other things could be things that like maybe the lender didn't see up front. Maybe you had some kind of bankruptcy that is no longer showing on your credit report. That can sometimes come back and actually kill a deal.
Oh yeah, because you've seen it all.
Yeah, I've seen similar things happen. Other things could be even as simple as like the rents have changed. You get approved for 95% financing because we applied with rents at a 3,500 in Calgary.
Yeah.
And today it's, the same unit is 2,800.
Yeah.
A lender might be like, hey, we're no longer willing to do
So
the
I know
COI.
some lenders, like the way that they operate, they hold back. Let's say if they approve for 95%, would they only front the cost of like 80 to 85% and then hold back a certain amount until the units are leased? Are you seeing that?
Yeah, there's one lender I can think of that will do that for every deal, but most small deals, they won't do that. Bigger deals, it's actually CMHC who's placing that requirement.
They just want to have all the units leased up.
Yeah, so
costs on it higher.
Yeah, so recently, this is actually a recent change as well. They've made it so that it's called a rental achievement holdback, and this applies to construction financing mostly. Yeah. So let's say you were building a couple hundred units, right? In CMHC's mind, there's quite a bit of lease-up risk in a project like that. And so what they'll do is they'll only lend you up to 75% of the construction cost.
Yeah.
And then only until after you've leased up the majority of the units and you meet a certain revenue target will they release that, and they'll fund the remaining 20%.
Getting to the 95.
Correct.
Yeah, no, that kind of makes sense in CMHC. And it also makes sure that who is dealing with the file, or the builder or the owner, they are financially strong enough to support any downfall.
Yeah.
Right?
Yeah.
Okay, so now the CMHC, we touch base on a few things, which is like the 3 pillars, which is affordability, energy efficiency, and accessibility. And there's always changes with a point system and everything like that.
Yes.
And so if you can touch base a little bit on what people are mostly focused in, let's say in Alberta, because our affordability numbers are higher, right? So what are you seeing here?
Yeah, basically, I would say almost 100% of our deals are affordability. And that is because the median renter income in Alberta is on the higher end. In other provinces like Ontario and BC, we do see a lot more energy efficiency deals.
Because you just can't charge a high rent there.
Yeah, exactly. Like in some, I think Toronto is like $1,000 or the affordable, which is like absolutely nuts, right? Compared to what we have here. In Calgary, it's the number that we have to meet is 1737. And basically how it works is if you want the 50-year amortization type of leverage, you need to have 100 points from affordability. And to get 100 points with a new construction product, so whether you're buying a new build or constructing a new build, 25% of the units have to be under the 1737 rent mark.
Rent cap.
Yeah.
Which is not bad in my opinion, because as you know, like if you're capping the basements for smaller units, you don't get that. Or if you're doing a larger multifamily, if you're doing just 1-bedroom units, 1,700 is still a decent rent in Calgary. Yeah. And what about Edmonton? What's the number we're seeing there?
I think Edmonton is 1665. I think that's the number for the affordable limits. Yeah.
Yes, that's fair enough. And then so affordability is good. We get 100 points, and I think for Albertans, like we just don't necessarily have to look into the energy efficiency or accessibility. Now with the CMHC insurance premium,
Mhm.
I know the premium just went up to almost 5% now, right? From 2.5.
Yeah,
How does that
yeah.
affect the deal now?
So
By the way, for people who doesn't know about premium, CMHC puts in you can explain it.
yeah, so basically because CMHC is an insurance company, they do have an insurance premium that you pay as you're funding the deal. The fortunate part about this is that it's not a cash expense for the client, for the borrower, meaning that it gets tacked onto the loan amount and it gets amortized over, 50 years or whatever your amortization is. With MLI Select deals, it was originally structured in a way that, if you kind of think about it, it doesn't make sense, because the higher the leverage that you get, the lower the insurance premium was. That's how MLI Select was structured.
Mm-hmm.
In 2023, they had actually increased the premium. It used to be as low as 1.2% to 1.25% for 95% financing, and they increased it to 2.8. And as of July 14th, which is next Monday, they're now increasing it. So now they made it to what I think is actually more reasonable, which is that the higher leverage that you get, the higher the premium that they're going to charge. And so on the highest leverage that you get, it actually works out to be about 5.8%, the premium.
Wow.
From 2.8. And so that is a big difference. And I would say that if you have a very long-term view and you're planning to hold this building for a long period of time,
10
it's
years?
like more than that.
Okay.
Well, even 10 years, it would be quite reasonable. This is not going to affect you that much because it gets amortized over that duration. You're paying it down from the principal and interest payments. But what this does affect is, like, if you ever have any, I guess, plan to refinance, let's say within a 5-year period, now you have to repay out a higher loan amount because it was tacked onto, the premium was tacked onto your base loan. Or if you were planning to sell a building, right, your profit is now cut because the premium, you have to pay out that mortgage, which includes the higher premium. So that's what I would see affect.
So, like, even with the higher increased premium, like if someone's thinking really long term, they can still take advantage of
Correct.
the lower interest rates that we can get compared to commercial, and traditional commercial, conventional mortgages, and the longer amortized period.
Yeah, that's right.
No, awesome. So I think we've covered pretty much everything about the CMHC MLI Select program this particular session, and thanks a lot for giving a lot of. I know there's going to be certain questions that we haven't touched base, but if you guys have any further questions or need any clarification, obviously Larry's contact information will be in the description. Feel free to contact him. And so in part 2 of this video, we're going to be touching base on how you structure your personal deal. And that's not a new build. So you can also fund, with the CMHC MLI Select for an older building. And we're going to touch base on that and break down the numbers for the Cochrane deal that you did here in Calgary. And anything else that we have to add in the session? Or
I don't think so. I think the only thing is, because I know we were talking about the affordable numbers.
Yeah.
There is talks, like,
You're
word of
break it
mouth.
down?
They're going to change those numbers, because I don't know if maybe the audience knows, but right now the median renter income numbers are based on 2019 statistics.
Wow. Okay.
Yeah. So we've heard that they might be changing that, and they might be updating it, which actually has a negative effect for Alberta. So we'll see.
Which is a federal thing too, right? Which will be all across Canada anyway.
So it'll be positive for every province except for Alberta, as far as I know.
Okay, big news coming, hey? Okay. Well, thanks a lot, guys. Thanks a lot for watching, and we'll see you in the next one.